What if the biggest promise governments make is one they never actually plan to keep? Every year politicians promise the same thing. They talk about reducing national debt. Budgets are debated, taxes are raised, spending cuts are announced. Leaders appear on television insisting they are finally getting the deficit under control. But something strange keeps happening. The debt never goes down, it grows. And it grows faster every decade. The United States now owes more than $34 trillion. Japan's debt is more than twice the size of its entire economy. Many European countries carry debts that would take generations to repay, and yet governments keep borrowing. Not slowly, but faster than ever before. So here's the mystery that few people stop to question. If governments know they cannot realistically repay the debt, why do they keep creating more of it? Is it simply bad management? Is it political short-term thinking? Or is there something deeper built into the financial system itself, something that quietly makes repayment impossible? To understand the answer, we need to go back to the moment when debt stopped being a temporary emergency tool and became the foundation of modern money. For most of human history, governments only borrowed money during extreme situations, wars, famines, natural disasters. Kings and emperors would borrow from wealthy merchants or powerful banking families. The expectation was simple. Once the crisis ended, the debt would be repaid. Borrowing was temporary, debt was dangerous, and rulers who failed to repay their obligations often lost credibility or their throne. But everything began to change during the late 17th century. In 1694, England faced a massive financial problem. The government needed money to fund a costly war against France, but traditional lenders were unwilling to provide the huge sums required. A group of private financiers proposed a new type of institution, a central bank that would lend money to the government in exchange for special privileges. That institution became the Bank of England. At first, this seemed like a clever solution to a temporary problem, but it introduced something entirely new. Instead of borrowing occasionally during emergencies, the government could now borrow continuously. Government debt itself began to transform into a permanent financial instrument. This moment quietly changed the architecture of the global economy. Before central banking, most money in circulation was tied to physical assets like gold or silver. But the new system operated differently. The government issued bonds, investors purchased those bonds, banks held them as valuable assets, and the central bank helped manage the entire process. Those government bonds were no longer just loans. They became financial building blocks. Banks used them as collateral. Governments used them to finance expansion. This created a powerful loop. Governments issued debt, and financial institutions bought that debt. Debt was no longer simply a burden, it became useful. Throughout the 18th and 19th centuries, borrowing allowed governments to finance massive projects. Every time the system required more money, governments simply issued more bonds. At first, this seemed manageable because the assumption was repayment. By the early 20th century, government debt had become permanent. 2 world wars accelerated this transformation. After the wars ended, the debts remained. And governments discovered something easier than repayment. They could simply replace old debt with new debt. When bonds matured, new bonds were issued. The process repeated. Debt wasn't eliminated, it was rolled over. Another turning point arrived in 1971. That year, the United States ended the gold standard, removing the last direct link between money and gold. The financial system had fully transformed. Debt wasn't just tolerated, it had become essential. Think about the incentives. Politicians face elections every few years. Voters expect economic growth, jobs, infrastructure, and social support. Delivering these benefits requires spending, but raising taxes is politically risky. Cutting programs is even riskier. Borrowing, however, offers an easier path. It allows governments to spend money today while shifting the cost into the future. Global government debt has surpassed $100 trillion, and yet almost no major economy has a realistic plan to eliminate it. We saw this during the 2008 financial crisis and the COVID-19 pandemic. Stimulus programs were financed largely through new borrowing. Modern economies have been built around borrowing. Removing that foundation too quickly could trigger financial instability. Most economists do not expect governments to fully repay. Instead, they expect economic growth and inflation to erode the value of old debt. The deeper question might be this: what happens if the world ever stops believing that the debt can continue growing forever? If you want to understand the hidden mechanics behind money, subscribe to the channel. The story only becomes more surprising.